Cooler inflation in the UK gives sterling some stability. While the pound held steady against the dollar and the euro as investors felt a sense of relief after UK CPI came in at a lower than expected 2.5% last month. But are investors right to breathe easy? Well, Francesco Pesole is an FX strategist from ING. Francesco, the pound held pretty much steady after the release of the data, but bond yields fell. Why is that?
Yeah, in general, kind of normal market conditions, you would have seen the pound depreciate after a kind of inflation miss, like we saw today, compared to expectations. And at the moment, however, the pound is acting a bit more like an emerging market currencies as opposed to a developed market currency. So it's more sensitive to kind of longer term borrowing costs for the UK as opposed to kind of the short term part of the curve, which instead tracks kind of what the Bank of England is going to do. So this is positive news for the gilt market that has been under quite a lot of pressure. Obviously, is kind of allowing a bit of a breather in this kind of gilt sell-off. And since sterling is more sensitive to that than it is to the fact that now the chances of a Bank of England rate cut in February are higher, then that means that actually the pound is not really losing ground at the moment.
So are you expecting a rate cut in February then?
Yeah, we've been calling for a rate cut in February. We think there was a shift in the last meeting of 2024 in sort of the vote split that seemed to signal there was sort of growing consensus for a dovish turn in within the kind of monetary policy committee, and that is what we've been calling a cut in February. And I think today's kind of inflation data endorses that view.
Well, another factor later today that's surely going to have some impact is the US CPI data. What are you expecting there, and what impact do you think it will have?
So yesterday we had PPI data in the US, which was quite lower than expected. However, there were some details in the PPI report, especially about travel costs, that are a bit worrying because they were expected to feed into a relatively hot 0.3% core CPI month to month today. And this is what we're expecting. Consensus is sort of split between 0.2 and 0.3 month to month. And we are favoring the 0.3, so we are expecting a positive reaction by the dollar and potentially another rough day for US bonds.
Now, overnight, the yen jumped after the Bank of Japan Governor Katsuo Ueda indicated there's a chance the central bank could hike rates next week. How big a chance do you actually think that is?
We think it's very high, the probability. Actually, we had thought there was a good chance they could have hiked already in December. So we've pushed that to sort of January. So we've been calling for a rate hike by the Bank of Japan. We think the narrative shift by Ueda does signal that there is also growing consensus behind that move. And for that reason, actually, despite we're seeing sort of a strong dollar throughout and it's sort of across the board, we're actually quite positive on the yen. We think it can really sustain kind of dollar appreciation better than other currencies that are more exposed, for example, to US protectionism or are generally kind of higher beta and cannot count on that sort of support that the Bank of Japan can give with a rate hike.
Francesco Pesole from ING, thanks so much for your insights. And don't forget, you can get more analysis on Reuters.com.